Chris Wallace with WG Financial Group has been helping families here in the Huntsville area plan for a successful retirement. Chris strives to understand all of your financial needs to help guide you on the path to your retirement goals, creating income in retirement, maximizing your savings, and minimizing taxes. Chris has the strategies you need to help you sustain a successful retirement. Welcome to the Rocket City Retirement Show with Chris Wallace.
There are a lot of things we protect in our life, but do you have a plan to help protect your retirement income? On our show today, we'll explain why you might want to consider it so that you can enjoy your ideal retirement. Hi, I'm Luann Fulmer alongside the president of WG Financial Group, Chris Wallace. Chris, great to see you again.
Yeah, great to see you, Luann.
Do you know what this is?
You know, I didn't. We were looking at that a little bit before the show. We started filming. I've actually never seen one of those in person out of a pocket before. So if I'm being honest, no, but I know it's a pocket protector now.
It is a pocket protector that men wear in their pockets. And I've never seen one in my life either. I haven't, but
Right.
So, that way the ink won't leak in the shirt and all that.
Kind of in the 80s, I think they were kind of synonymous with nerds.
Nerds?
Right? And if I remember right, the Beastie Boys video, there was
You cracked me
a
up.
nerd in You Gotta Fight for Your Right to Party, and I'm pretty sure he
that's
had
so
a pocket
funny.
protector, but I didn't know it was like a little pin wallet, if you will.
It's like a pen wallet.
Yeah.
That's a good thing, yeah. So the funny thing is we protect our pockets, my goodness, from everything. Our phones, right? We keep them in a case so they don't fall out. We protect our children, making them wear the helmets, when they're riding their bicycles.
We put a raincoat on because we don't get wet.
It might rain.
Might melt.
Take an umbrella.
Right,
Yeah.
right.
I mean, we put seatbelts on every time we get in the car now. We didn't do that when I was a kid, So I don't know if that means my parents didn't love me as much. I don't know, but we didn't wear seatbelts. We didn't wear helmets. We drank water out of the garden hose, all that stuff. But no. So my point is, we protect our pockets, and then we're not protecting our income in retirement. So that's where I want to go with this right now. I want you to tell us, what it is we need to protect our money from. Give us some examples.
Yeah, it's pretty amazing to me. This kind of goes back to when I first started planning, where I've seen individuals and families not protect their income. And in other words, what I mean by that is that they're not making the correct decision mathematically because maybe they're worried about something happening, or maybe the way they were raised, or information they've heard, read, talked about at work over the water cooler or by the water cooler. At the end of the day, I think it's best in retirement. I believe in picking up guarantees where we can, so protecting income. So I'll give you an example where I'm kind of headed with this is Social Security. There's a lot of emotion around Social Security. There's a lot of people that think that Social Security is going to go broke, the money won't be there, so they're in a rush to collect it. Now, mind you, I've sat with a number of people that have come back to me and said, after I've worked on their plan and they've already started collecting, there's nothing we can do about it. And one of the things I've heard a lot is, Chris, I wish I would have waited a little bit longer to collect Social Security. I didn't know some of the things in the way that you look at. I didn't know about those things back when I decided to collect. I was just worried about it running out of money, so I made a rash decision to do that. I've even sat down with a couple of pastors. Back in the 80s, you were allowed to opt out of Social Security. So the mindset was, I'll opt out of it, and then I'll take my own money that I would have put into Social Security, and I'll invest it. Well, guess what happened? That didn't happen. So, I've seen people, it amazes me how they will forego guarantees and things to protect their income just based on personal beliefs. So I think you got to be really, really careful with that. Social Security is one of those.
Okay, and I was going to say, give us some other examples of protected income besides Social Security.
Yeah, so Social Security obviously is one. It's going to be the foundational piece to most individuals and families' retirement plans. Then you have pension plans. Those are also very important. And I've had this conversation a number of times where I've had an individual or a family come into the office, husband, wife, come in the office, and they want to take the pension lump sum buyout. And I'm like, wait a minute, why are you wanting to do that? Well, I'd rather have the money in my possession where I can invest it, and I think I can outperform what the pension is going to pay me. And I'm like, wait a minute, there's no guarantee that you're going to be able to do that. So let's run some numbers. Let's look at the cash flows. Okay, that makes sense. It makes sense to take the pension because the cash flow rate out of the pension in terms of payment is probably going to be better than what you can, perform long term. In addition to that, in the state of Alabama, if you're taking income from a defined benefit plan, i.e. a pension, there's no state tax on it. So if you take that lump sum and you roll it into your IRA, you're going to be taxed federally. You're also going to have a state tax, an Alabama state tax obligation as well. So a lot of people just overlook that. Frankly, they're probably not aware of it, is why they overlook it. But this is why conversations with us is kind of helpful.
There's a report from the Alliance for Lifetime Income, and it says that the number of protected households is at about 40%. And I guess it's getting better, they say, but that means 60% of us do not have protected income. So what I want you to tell us about is, what kind of challenges are we facing if we just have maybe money and not protected income?
Yeah, so let me make an example. First of all, if you had a job where they paid you one wage 1 week, one wage the next week, one wage this week, different wage the next week, that's kind of maybe.
Right.
Maybe you're going to get the same amount, maybe you won't.
Okay.
So when you do not have guaranteed income in retirement, you are solely relying on the market to perform. Now, many viewers out there have probably heard of the 4% rule. The 4% rule requires you to be flexible. It requires you that when your portfolio is down, you're going to take less income. Let's look at an example. Say you have $1 million in your portfolio. Okay, you start out, that's $40,000 a year. The portfolio now drops in half. Let's say it's $500,000. Well, guess what? Your income for the following year has to cut in half. Most people can't afford that up and down in income, and that's why I think guaranteeing out income can kind of smooth out your retirement plan. What you're trying to do with guaranteed income, Luann, you're trying to recreate your paycheck.
Sure.
Which is why I brought that up
makes
in
sense.
the beginning.
Yeah.
That's comforting for me and everybody else out there drawing a paycheck. That's comforting to know that every other week I'm going to get a set amount into my bank account, and I know I can cover my obligations, or hopefully cover my obligations with that set amount. Well, that's kind of what you want to do in retirement. You want to recreate that feeling of that guaranteed income. We even encourage our clients to take deposit. So you're going to have Social Security coming in at a certain time in a month, and if you have an annuity coming in at another time, you want to spread those out so that it feels like a paycheck. Retirement is also about feeling comfortable with the way that things are coming in. So you want your income stream in retirement, in my opinion, to feel as much like a paycheck so that you can kind of relax a little bit.
Right. That makes so much sense. And we do need to have that, I don't want to say, just that confidence that income is going to be there.
We do. It'll also give you a longer term outlook on your portfolio, because if you're working today, you're not worried about your portfolio as much, especially when you're in your 30s, right? You never look at it. You're just like, feed it. You want it to grow, and it probably has grown, but you don't need it. Well, if you have enough guaranteed income coming in retirement, you don't really need the portfolio to sustain the type of retirement you're looking for, because you have the income to be able to do that for you.
Great information again. Protected income may be important, but how do you know what kind is right for you? We're going to get into that with Chris when we come back. The Rocket City Retirement Show continues right after this.
Just when you may want to forget your age, Uncle Sam says not so fast. Knowing your age is more important than ever when it comes to taking your required minimum distributions, or RMDs. Legislation just changed the age requirement, and not accounting for that could impact your retirement plan. It could be key to not overpaying on taxes in retirement. So remember, when it comes to RMDs, age is more than just a number. Before your next birthday, call today to secure a strategy for the RMD age change and your retirement. There are some things you can't avoid, but you can avoid overpaying taxes in retirement. You may think your taxes will go down in retirement, but that's not always true. In fact, sometimes your tax liability could go up. We're offering a free guide to show how you may be able to pay fewer taxes in retirement. Learn how different retirement accounts are taxed and options to help make your retirement income more tax efficient, all in easy to understand terms. Download this free tax guide now to help keep what's yours and avoid overpaying taxes in retirement. Planning on passing your IRA to your children or grandchildren? That could be more of a burden than a blessing due to the recently passed Secure Act. This legislation eliminates the stretch IRA, which means now when loved ones inherit an IRA, they could also be inheriting a huge tax bill. Now's the time to sit down with a trusted advisor to find out how you can maximize the legacy you want to leave. Call today to find out how the Secure Act could affect you and your retirement plans. Don't let taxes dictate your legacy. Call now and leave a legacy you feel secure about.
You're watching the Rocket City Retirement Show with Chris Wallace.
We've been talking about the importance of protected income, a big topic. So how do you help someone have more confidence with their income picture in retirement, Chris?
Yeah, Lou, and it starts with a plan. I think sitting down and developing a plan, and then being actively involved in that planning process with your financial planner. The more that you can learn and be educated along the way, the more comfort you'll feel in your overall plan. And think about it this way. You're not going to do something that you don't understand. In other words, if you need to make a decision on something, if you don't understand it, you're not going to make a decision on it. You're much more likely to have the deer in the headlights look, and you're like, I don't understand this, so I'm not going to make the decision. Working with a planner, establishing an overall plan will help bring about some comfort, to your life in retirement. So it starts with the planning process. Let's identify our sources of income, right? We need to know where the income's coming from. When is it coming? When is it coming in? And then we need to look at our expenses. And that's one area that I can encourage the viewer, if you're in your pre-retirement years, to start looking at your expenses. If you're a male out there, you're in batting practice right now. It's time to start taking those practice swings before you get in the game called retirement. If you're a female, it's dress rehearsal. We want to understand what it's like before we get out there on stage. Let's start going through dress rehearsal and make sure that we're understanding how much we're going to spend in retirement, because retirement's going to revolve around income and expenses. If your expenses exceed your income for a long period of time, that means you're going to have to turn to the portfolio, pull money out of the portfolio to support the excess expenses that you're generating. So start learning how to control that early on in pre-retirement so that you can kind of glide right into retirement. So look at the shortfalls, identify the income, and then you start working on the investment plan, and then taking a look at how we can pull money out of the portfolio in a tax efficient manner. And then of course, as we pass away, how we want the money to pass on to our heirs. Now all of that's a big process that I think a family needs to walk through with a financial planner. I've seen a number of issues on spreadsheets that I've reviewed by individuals and families that come out there. And I'll give you an example regarding expenses. Not everybody uses a budget. And full disclosure, I don't operate on a budget every single month. I know how much I'm supposed to spend, but then there's something called the Amazon factor. And that's
For all of us, I think.
Absolutely. And so that's, you have to build that stuff in the budget. So I know I'm supposed to, survive every month on X, but then my daughter comes to me and says, hey, Chris, I need
No,
that.
she doesn't. She says, hey, Daddy.
She says, hey, Dad, you're right. That's what people say. Hey, Chris. My daughter says, hey, Dad.
Daddy.
And it starts with a phone call on the way home from work. Dad, when are you going to be home from work? And I'm like, an hour or so. And I know something's up. She's just basically, and then she comes out with, hey, can I buy this on Amazon? So that's how it works in my house. But it's the Amazon factor. And I think a lot of people need to have that built into their budget. I also look at a lot of spreadsheets where I'm like, where's your groceries at? Like, I see all your utilities, but I know you have to eat. Where are your groceries at? So really taking a deep dive into that. And that's why I think sometimes it's good to sit down with someone so that they can bounce ideas back and forth with you and say, hey, did you think about this? Because remember, this is what I do every day. If I came into your job every day, I would be lost for many days and weeks until you taught me how I'm supposed to do your job. So I think hooking up with a financial planner is important.
Of course it is. And I can imagine so many people viewing right now, everybody wants that protected income, but they kind of don't know how to get it. So, I want to talk a little bit more about options for protected income, please.
Yes. So first of all, I think making the right decision on Social Security for your family is number one. Again, that is going to be the foundational piece of everyone's retirement. And then we can kind of move into, if you have a pension, then we want to make the right pension decision as well. I think that's incredibly important. If you have both of those and your expenses aren't crazy, you're probably going to have most of your retirement covered with Social Security and a pension. there are a lot of families that don't have a pension, and that's kind of where I think your question is going. What do I do? How do I go about doing that? So there's a number of different ways you can generate income in retirement. There are dividend stocks, there's bonds, there's rental properties. The problem with all three of those is none of the three are guaranteed. None of them. We all know that if you have a rental property, the renter may not pay you, or you may not have a renter for a while.
Right.
We also know that bonds can be called and they, expire or mature rather. And then we have dividend stocks, and we know that companies can reduce or eliminate dividends. So none of those are guaranteed. We also know that when we retire, the vast majority of us are going to need a set amount of income. We're not going to need an income stream that varies, because that's going to create anxiety in us. Like I mentioned earlier, think about your job. What if your job paid you this much this week and a lesser amount the following week, and it bounces around? That would create anxiety when you're working. Well, trust me, when you go into retirement, that anxiety is going to 10x what you're feeling right now while you're working, because you're not going to have the comfort of that stable income, right? So the stable income stops, and you're thinking, this is all I have to make it last. So you're going to have a tendency to want to just hang on to that money. You don't want to spend it. You're like, oh my gosh, I'm going to run out, because most people fear running out of money. So sometimes it makes sense, if there's a pretty good shortfall and there's a lot of stress being put on the portfolio. We run the Monte Carlo, and the Monte Carlo, the simulator on your retirement, is starting to stress a little bit. Sometimes it makes sense to look at another source of guaranteed income, where you might elect to look at an income annuity. An annuity is just going to provide income for life. When you're looking at annuities, it's important that you work with a highly rated insurance company, because they are backed by the claims paying ability of the insurance company. But essentially, and I've said this before on other shows, a pension and an annuity, they're synonymous. They're kind of very similar. They both provide income. But if I ran across you in the Home Depot parking lot and I said, hey, Luann, would you like a pension? You would be like, yes, I'll take a pension. Of course. I say, hey, would you like an annuity? You're like, Yeah. They kind of do the same thing in terms of income.
Right. So true.
Protecting some of that income, like we're talking about, that for some families makes sense. They're not right for everybody. It's really family dependent on their specific retirement situation.
Right, of course. So now taxes, we've got our retirement income. How are taxes going to impact that income?
Yeah, which, when we're talking about taxes, we go back to Social Security. Let's just start there again. This is why Social Security is such a huge decision for many families, because the more Social Security income that you have coming in your household, from Social Security, really the more tax efficient your overall situation is going to be. And I've said this before, and I'll say it again. If you just have Social Security income by itself, you're in a zero federal bracket. And in the state of Alabama, they don't tax Social Security. So guess what? You don't have any taxes due at that point. But it's when you start adding pensions, IRA distributions, capital gains, that's when you start throwing in the additional tax that may be owed by you, or you and your wife, if you're married, or you and your husband. And so I think it's important to look at that and formulate a withdrawal strategy that is going to be most efficient on the tax return, because at the end of the day, we all want to pay what we're legally obligated to pay. But there's also a tax code that allows us to utilize the tax code in terms of withdrawals that can make our retirement a lot more efficient.
Okay, so again, get some guidance on tax strategies of retirement. You can do that with Chris Wallace and his team at WG Financial Group. Coming up, we're going to answer some of your retirement questions. The Rocket City Retirement Show continues right after this.
There are some things you can't avoid, but you can avoid overpaying taxes in retirement. You may think your taxes will go down in retirement, but that's not always true. In fact, sometimes your tax liability could go up. We're offering a free guide to show how you may be able to pay fewer taxes in retirement. Learn how different retirement accounts are taxed and options to help make your retirement income more tax efficient, all in easy to understand terms. Download this free tax guide now to help keep what's yours and avoid overpaying taxes in retirement.
You have a club for every scenario. A driver for the long holes. Wedges to get you over the hazards. And a putter for when you need a touch of finesse. What about your retirement? Will you have enough to play the back nine? Call to set your 15-minute phone visit today, and let's find out. Get a second set of eyes on your retirement plan.
You're watching the Rocket City Retirement Show with Chris Wallace.
Hi, we're so happy to have you along with us today. This is the Rocket City Retirement Show with my friend Chris Wallace of WG Financial Group. It is time now for our questions from viewers. So excited about this one. This first one is from Scott in Huntsville, and he says, we have a small mortgage on our home. Should we take money out from our IRA to pay it off now, or just pay it off over the next 6 years?
All right, so there's a mental struggle going on right now with Scott, right?
Yeah.
There's this big drive to be debt-free.
Yes.
And I'm all for that. And we all should be working our way to become debt-free, because it's never fun waking up knowing that you owe somebody. But then there comes the math decision behind things. So Scott's probably paid the vast majority of his interest through the first, part of his loan. He's got 6 years left.
Right.
I think he said he has a small house payment.
Yes.
So we're talking a small
mortgage.
House. If he says small mortgage,
Yeah.
that leads me to believe, okay, it's relatively insignificant.
Yeah.
But it's the kind of the weightiness of still having that house payment. My assumption is he's getting ready to retire. Here's what you're faced with. You're probably not going to pay a whole lot of interest in the last 6 years of your loan, assuming he's had a loan for a while. So I'm assuming he's got a pretty good interest rate. Yeah. So let's just say, for an example, he owes $100,000 on a house, and you pull that out at the 24% marginal bracket. That's $24,000 in federal that you're going to have to pay in taxes. So $24,000 in federal taxes, and you're going to pay another $5,000 in state. If we use just a rough 5% for Alabama state tax. So now we're at $29,000 to pay off the house so that I feel better. When the math might mean, hey, I'm going to pay $29,000 in extra in taxes, but my interest might only be several thousand over the last 6 years. Again, you have to run the numbers and look at that. Depending on where they're at as well, you also have to look at the IRMAA limits. So if you're within 2 years of being 65 and you're about to go on Medicare, there could be a potential that you may bust into those IRMAA brackets, which are going to drive up your Medicare premiums and your Part D premiums. So again, it's always best to seek financial counsel on something like this, as well as tax counsel as well.
Okay, very good. Next question we have is from Alice in Decatur. She says, I'm 59 now, and I plan on working until I'm 66. Should I roll over my 401k while I'm still working?
Good question. Really good question. So this is actually one I'm surprised it was given to us, right?
Yeah.
A lot of people aren't going to ask this question.
No, I know.
So there is something called an in-service rollover, where once you are over the age of 59 and a half, your 401k plan may allow you to do what's called an in-service rollover out to an IRA. There's no taxes in doing so. You just roll it over to an IRA. Mm-hmm. That's a big decision for a lot of families, and there's a lot of factors that go into this decision. So one of those might be, you can look at your current plan. Maybe you have a limited number of investment choices. That could be kind of a restriction for you. I might not be able to get where I'm trying to go over the next several years because my plan is limited. I just have limited choices. You also have to look at, where are you trying to get to by age 66? So are you looking for a specific amount of money to accumulate? Or do you need to have a certain amount of income? That's a big deal. This show, we've talked a lot about protected income. Do I need to have a certain amount of income? And do I have, between age, you said 59 and a half, right?
59,
to 66.
Yeah.
So we've got roughly 7 years. Can my portfolio, under the right conditions, grow to the necessary amount by 66 to provide that level of income? So here again, another question is, I would say it's worth a look, but I also think it's best if you sit down with someone like our group, that can help you understand whether or not you should do that and where you're trying to get to at age 66.
Okay, very good. Thank you for that question, Alice. All right. Here's another question from Marcy in Ardmore. She says, my husband and I are really conservative with our money. Of course, we've been experiencing inflation on the rise. Could there be a way to keep some of our money growing without taking on too much risk?
Oh, there is, absolutely. And inflation's been on the rise, hasn't it? I mean, good grief, look at the, every time I hear Ardmore, I think of the Sonic that's there.
Oh, yeah?
Yeah, because I've stopped by there a number of times. I love cheese sticks. I have a major addiction to dark chocolate and cheese sticks.
Oh, really? Did not know that. You eat fast food. Did not know that.
Oh, yes, I do. Oh, yes, I do. So got to balance it. You know, the dark chocolate
Yeah.
supposedly healthy,
healthy.
in moderation,
Yeah.
right?
Yeah.
And then cheese
Right.
sticks kind
Right.
of balances out. So anyway, inflation's been on the rise. Just check the price of cheese sticks lately. Is really what I was going to say.
Yeah,
So yeah, there are opportunities out there for families that are, you know, wanting to take less risk, and then, you know, investing in vehicles that allow them to still achieve growth that has the potential to outperform inflation while not taking a lot of risk. That's something that we do at the office. We're able to sit down, go over the entire plan and their situation with a family, and then we can make some recommendations. So the short answer to the question is not about cheese sticks, but rather there are options on the financial side that I think could help them out.
Okay, very good. All right, we have another question. This one's from Jose in Athens. And he asks, how much money can you inherit without paying an inheritance tax?
Great question. This is a fear for a lot of families. They're worried about at death, are they going to incur some sort of inheritance tax? Good news is the state of Alabama does not have an inheritance tax. So that's great news.
Very good.
The other great news is per a couple, you know, you have like a $27.2-ish million exclusion before you get into what's called the inheritance tax.
Oh,
So yeah, exactly.
lot.
It's a whole lot of money. A lot more
Yeah.
money than a lot of
Most
people
of us
watching
have.
this show have.
Yeah,
Like
yeah.
99% of the people watching, 99.9% of the people probably watching the show aren't going to have more than that. So
Right.
I don't think the inheritance tax is something that we need to worry about. But what we do need to worry about are how the other assets are going to be transferred to our heirs and the taxes that they may incur. So I'll give you a couple of examples here. I'm a big fan of HSA plans.
Yes.
I love them. I own one myself. We don't sell them, we don't get compensated for them, but we often will recommend families look at them as an opportunity for their retirement plan. Now, here's the thing, they're the worst vehicle in the world to die with. Why? Because the assets that are in the HSA, the taxes are due in the year of death. So it is the worst vehicle to die with, in my
okay,
opinion,
okay.
because taxes are due right then
Right.
in that tax year. Okay, so that's a problem. But before that, they're great. All right.
Yeah.
Let's take a look at IRAs. We know that we can pass away with an IRA, and we know that our beneficiaries they have the ability to roll it into an inherited IRA if they're a non-spouse. So they have the ability to roll it into an inherited IRA, and they literally have 10 years to take the taxes or to take the IRA money out of IRA status and pay all of the taxes. Now, you can do that a little bit by little bit each year if you want, but if you're still working and your salary is like, say, $200,000 a year, you may not want to take the money or take the distributions. You may want to wait until you stop working. So it's not the inheritance tax that I would be worried about here, and I respect the question, and hopefully we've answered that. Great question. It's the other taxes along the way that you may want to be concerned with, you know. So let's take one more step here, and then we're probably going to have to wrap this up. But we got capital gains. If we have equities that we inherit, those are inherited at a stepped-up basis, so there is no tax. So there's a lot of good things in inheritance that we don't have to worry about there being a tax, and then there's some other things where we do want to be, you know, concerned and at least knowledgeable about.
Well, Chris, as always, thank you so much for sharing with us your wisdom. If you have your own question, submit it, and we might just answer it on a future show. And if you want to know how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, reach out now to start planning for your ideal retirement. For Chris and the team at WG Financial Group, I'm Lou Ann Fulmer, wishing you a healthy and happy journey to and through retirement.
This program was sponsored by WG Financial Group, where your retirement matters.